that we're flagging is a lot sort of like what you just were talking about. That and this is a very overcomplicated chart here, but I'll bring it up for one reason. If you remember back at the end of April 19th, it was right before VIX expiration. Powell spoke, I believe, on that day or the next day, and there was this weird move in the market where it rallied about 100 handles in the S&P, and that's basically this move right here. And this was the VIX got drop kicked. I mean, it just tanked. And VIX expiration is at 9 a.m. on Wednesday. The VIX closed right at 20 at 9 a.m. on Wednesday. And then it just sort of it hung out there on Thursday. And then Friday, we had a pretty big reversal. And that's what this is. This is Friday OPEX right here and a pretty big drawdown. So the synergy to me is like it's so similar because, again, this morning, like futures were up a lot. And then, I don't know, there was like a couple of like people were searching for a narrative, it felt like. Right? There wasn't a strong reason. And please correct me if I'm wrong on that. But I didn't see a strong reason as to why the market was going to be up, especially ahead of Powell at 2 o'clock. And this idea that, again, last time it was the Tuesday before VIX expiration that there was a real strong rally. We got such a similar move today, and it's another, put heavy expiration on Friday. And so there's these positioning dynamics, I think, that I think catch some people off guard. Like everyone wants to say this is the bottom, we're going to rally real hard here, or this is the end of the world right here. And it doesn't all have to happen in one singular move, right?
Yeah, I mean, I don't think there was necessarily that strong a reason for the rally. I mean, Friday, we got some optimism out of China saying that, their COVID restrictions
Right.
might be getting lifted towards the end of the month, let's say. So the market kind of took that as a positive. People were also saying that the Fed, the rhetoric out of the Fed speakers was that, we're going to do 50 bips in the next two meetings, and then maybe we're going to pause and see the impact of our hikes, right? So that was kind of a slowdown in the pace of tightening later in the year that kind of was taken positively. So I'd say they were maybe the things that kind of lit the match to get the rally going. But then, we were coming from a place where VIX was still, around 30 or above, and things were a bit oversold. Sentiment was pretty beaten up. So you don't necessarily need that much of a reason just to unwind some of that bearishness. And if you look at some of the most shorted stocks, they were leading us out of this, right? Like the ARC names were rallying hard. I think ARC bounced like 20% off its low, something like that.
I don't mean to laugh. I'm just looking at this move, and you go like, I mean, that's a big move here in the last 2 days.
Massive. It's
crazy.
Yeah.
It's up 20%, but look at this chart. I mean, holy cow.
Yeah. When you get leadership from the shittiest parts of the market, it's nothing more than a short squeeze, really.
Yep.
Right. So.
Yeah. You bring. I mean, that's a beautiful point, right? And it's something that sinks. I mean, 1 month realized volatility is up around I think 28 in the S&P right now, and so the market is pricing in big moves. That's what we've been getting, and a very big put heavy position. So I couldn't agree with you more. And that's why we say like a lot of times when we're getting these rallies, they're short cover rallies. And so don't count on them being stable, longer term, moves or shifts in sentiment. I know Walmart reported last night. That's obviously not looking very good. Someone else just mentioned Home Depot, which is, hanging in there a little bit better than some of these other things. But look, I mean, I think last week was so interesting, and it's a segue here that we did break this 4,000 level, which we've been talking about for a while. But as we march towards, again, this very messy chart here, we're going to lose about 30% of the S&P options gamma position on Friday, and NASDAQ is basically the same. So, yeah, we tested and broke below, and it was a pretty violent drop, but, we pop rated back above 4,000. So, in our view, we're clearing out some of the VIX position. It's a very big VIX call position in the market right now. We're clearing out some puts below. Here we had I think crypto liquidation was a big driver. Any of those crypto names that were in the market just got, absolutely smoked. I know you want to touch on crypto for a second. So I think this is just, again, you're right, positioning. We're going to bounce here, and Powell's probably not going to change anything that he's forecasting. Nobody knows really what the path of interest rate increases are. Love to hear your comments on that as well. But I don't think anyone can forecast any material fundamental. No one can provide a fundamental forecast for what any given tech name or really kind of any name in general is until we know exactly how many hikes are in, what is inflation going to do, all these other things. So it's really, why is anyone buying here, right? Really?
Yeah, well, exactly. That no one's buying because they've got a bullish fundamental view right now. I don't think. Certainly not over the next few months. Right. I mean, all of the sort of respected macro commentators seem to be pretty bearish,
Yeah.
with targets on the S&P. 3,500 to 3,000, somewhere in that range, for a number of reasons, obviously. Pretty much in a nutshell, it's saying that the only power the Fed has to have any impact on inflation is to, bring the stock market down and bring the housing market down, right? And create this
Hmm.
reverse wealth effect. That's their only tool, and that's the tool they're going to use, right? They can't do anything about oil prices. They can't do anything about food prices from the supply side.
Or
All they
war.
can deal with is the demand side, and they're going to do that with rate hikes, basically. Now, the only sort of saving grace might be that as we've started to see some growth concerns come in, and most of those have really been coming from China, right?
Hmm.
China's lockdown has impacted Chinese growth. We've seen some horrible macro data out of China over the weekend. Worse than expectations, even though expectations were already going to be low. So whilst China is happy to beat the shit out of their economy, that's not good for the global economy, right? And that's reducing demand, that's creating commodity prices that are rolling over a bit, and that allows maybe the Fed to slow down a bit on rate hikes,
Hmm.
right? That's kind of the balance. We're kind of toing and froing between, are we going to go into a recession? And if we are, that's almost being met by a rally in the market to say, okay, that means the Fed's not going to screw the market too badly because growth is so bad, right? So
Yeah.
that's kind of the tug of war that's going on right now. Yeah.
It's very well put, and I think that um, the idea basically the Fed's going to keep going until they break something is basically what I have in my head. And to your China point, I saw this on Twitter, and don't please, I see a lot of things on Twitter, but apparently Shanghai didn't sell a single car last month. And even if that's off by a magnitude of 10, that's still an unbelievable
Yeah, I
statement,
mean,
right? I mean,
yeah, retail sales, industrial production, they were all like negative prints, right? They proper screwed their economy. I mean, the reality is though, it's got to be temporary, right? I mean,
yeah,
yes, their policies seems a bit crazy, like how strict they are with
yeah,
like a handful of cases or deaths or whatever it is, but at some point it's going to stop and they're going to reopen and they're going to let people do what they want to do, and that's going to in theory create a bit of a impulse of demand, and things will come back, right? So I think we've got to be careful there about getting too bearish. And then on top of that, they've been talking about stimulating, right? They've been talking about infrastructure packages and stimulating, and I think late in the later half of the year, a lot of that is coming, right? The Chinese cycle is quite far ahead of ours, and is kind of inflecting higher. Whereas we've still got some pain to come over the next few months. China's kind of coming out of the other side of their pain. They've been in the pain for much longer, and so I feel like there may well be a trade in there to get long China somehow via call spreads or whatever when we get the green light that yes, they've reopened, yes, they're stimulating again, away we go. But right now, risk assets overall, you want to be cautious, and US risk assets, you want to be extremely cautious, and probably use these rallies to either raise cash or get into short positions. Right.
yeah. I echo that sentiment, at least in terms of the U.S. markets as well. This is the K-Web, the internet, the Chinese internet ETF, and the destruction there is just, I mean, it's really something else. And oil is the other one that came to mind when you're talking about China maybe coming back online, because that was sort of a story as to why oil paused in the first place, right? And I think we're up around 113. I think I have that in here somewhere, but oil's a little bit over, I think 105, and maybe whatever it may be. And if China does come back online and oil has been able to maintain that $100 level, I mean that could be a real second leg there, as that narrative of like, well, Chinese oil demand or energy demand is really kind of tanked here. That was a good pun, but
Yeah, no, you're absolutely right on that front. I mean, the thing to watch on the oil is that it's compare it to the metals. The metals sector is getting crushed, right?
yeah,
Industrial copper, aluminium. I mean, you look at the aluminium chart; it is frightening how much that's come off, right? But whereas oil's holding in there, and it's holding in there for a number of reasons, right? OPEC is struggling to meet production quotas, right? So OPEC spare capacity just isn't really there. Obviously, Russian sanctions are hitting supply. Um, We've got potential sniff that China COVID situation is improving. And then the US is entering, well, right? US is entering peak driving season. European air travel is holding up. All these things are showing that the demand side on the oil isn't really collapsing like you think it would. And the supply issues are still there, right?
Right.
So that's what we're seeing.
Yeah, it and I mean the commodity volatility too is it's been remarkable how much it's kind of come down, and I'm not sure how much all that continues, but the energy stuff, the stuff where there's real supply issues, seems like it's going to continue, because if you get obviously the economy coming down, the Fed just looks like Fed says, look, we're going to just completely stop the economy here to just crush demand, and that's going to bring prices back in line. It still doesn't fix oil production in so many ways, and I don't know what oil prices and gas prices are out there in London where you are, but diesel here is $6.50 a gallon, which is the highest price I've ever seen, and you start to talk about some of these things. Well, companies now, like the fundamental sort of lifeblood of our economy is trucking, and that's how everything happens. Definitely here in the United States, and they start to worry about not just the cost, but is there going to be a supply, just period, right? So
Yeah. Sadly,
hope,
those products like diesel, gasoline, jet fuel, those prices have just gone parabolic, right? I mean, they are one of the big reasons as well why crude prices have been well supported, right? Because the prices of the products are just going crazy. Yeah,
yeah, and
so
I'm not sure
totally
if I
agree.
have that gasoline chart here, but at any rate, I think we're along the same in the same frame of reference here. That again, there's no reason for the Fed to sort of back off or offer support for this market. We're going to get this sort of positioning rally, and we're getting like these cascading destructions. I mean, first it was the meme stock destruction, and then I want to pivot slightly to crypto, because that was a story of last week. You track the crypto market closely, and I think even if you don't at this point care about the crypto markets that much, um,
You have to.
when these
Sentiment.
companies start, right, when you get Coinbase and MSTR, and yeah, these are all smaller cap companies, but if you start to get a liquidation events there, credit events there, that just adds like some whipped cream on the bear Sunday, I guess.
Yeah, I mean, it was a pretty epic move in crypto. I have to say, it's probably one of the worst weeks in a long time. $50 billion of market cap wiped out between Terra and Luna.
Yeah,
Uh, I mean, I was never invested in Luna or Terra. I mean, I stick with the large caps, right? So my exposures are Ethereum and Bitcoin. I dip my toes a little bit in Solana, but that's about as far as it goes. But the idea that these guys were like, trying to have a stable coin and then back it with Bitcoin collateral, and having collateral that is an 80-volt asset against your stablecoin sounds a bit nuts, right? Like if you think about it. I mean, I don't know. I'm sure they had reasons to think that it would work. Clearly, they were proven wrong, right? But and they got taken to the woodshed. But in terms of crypto markets overall, we were looking for a downside leg. We thought it was going to be driven more by the equity sell-off than anything particularly crypto specific. Obviously, this was a catalyst for it to be a bit more crypto specific, but we had a big flush out. The altcoins got absolutely destroyed. Solana, AVAX were down 50% a piece. Even Ethereum touched 1700, right? Which, a few weeks ago, you were looking at that was miles away, right?
yeah,
So I think we've reached some quite interesting levels. If you obviously you look at vol and skew, so skew. I mean, just think about this, right? 25 delta skew in the short dates got to like 30 vols basically for puts over, right? That's astronomical, right? That's pretty much as high as it ever gets. It got there in May last year when China was liquidating and getting out of crypto. So the fact that it managed to get there so quickly kind of gave us a bit of a signal that things are probably a bit overdone now.
yeah,
And then after the Terra peg went, they started to go after Tether, right, which is obviously the biggest stable coin in the market. They're trying to break the Tether peg, and that actually traded down to around 0.95 or something, but managed to recover because it redeemed about $7 billion worth and showed that it had the money to be able to do that. So that kind of recovered. That went back towards parity with the dollar or close enough. And then that's where the recovery came in. And we got a nice 10% bounce off those lows, right? So on Friday. So that was an interesting time.
yeah, and that's a very succinct analysis there. And we were looking at some of these names like Coinbase. At one point, somebody flagged yesterday, or it was late last week, that the January straddle in Coinbase when the stock was trading around 50 was going for $45. Well, that's what the straddles were, which
Wow.
is like, man alive. And so what I love in this market is you get such incredible vol there. It reminded me of meme mania a little bit, only those were crashing up, where vol just blows out and skew gets so crazy, and all these wild things are happening that you can find some great risk reward in those situations. And it's these liquidation events, right? That
Yeah.
sort of, whether you're liquidating buying to cover or selling, selling short.
But
Um,
that's a perfect reason why you need to have some cash on the sidelines,
mhm.
right? Because that's exactly what happened, right? I didn't look at the vol market in Coinbase because I assumed that it was pretty untradeable, right? Given how volatile things were. But because I had cash on the sidelines and I had already got a small Coinbase position, which was massively underwater, but down at $42. I mean, it was a no-brainer to double my position, right? So I was able, because I had that cash lying around, I was able to then double my Coinbase position in the 40s, and 2 days later, it's back in the 70s again.
Mhm.
Right? So then so by having that cash, I've now flipped out that position that I bought in the 40s, and I've basically got my cost basis down on my residual position that I started with. So everything I was underwater, I've kind of made it back by
Mhm.
being able to opportunistically buy that ridiculous crash that had happened, and then when it opened down, I think it was like down 20% 3 days in a row or something
Yeah.
like.
Yeah. I mean,
Yeah,
it's been unbelievable. And the nice thing, I don't want to say the nice thing, but the thing here is you understand the catalyst, right? We're aware of what the catalyst is. We're aware there's a lot of fear. And people start talking about Coinbase basically, defaulting and these kinds of things. It's that sentiment gets extreme, and that's a great place for options because you have that fixed risk reward. Now, just sort of in general, when you get these high vol environments, how do you like to play upside with options? Because we've talked about before that you don't really want to buy calls when vol's just through the roof, right? Because if you do get a rally, vol's going to come down, so your calls really don't pay off. So do you typically look at 1x2s, or what's sort of like a
yeah,
go-to
yeah,
strategy
exactly.
there?
So the type of structures that I was doing in crypto when we were at levels where I thought, okay, we kind of bottomed out, we've probably got a 10-20% rally. Generally, very short dated,
Mm-hmm.
call ratio structures. So what did I do? So like with Bitcoin down at 28K, doing something like the 30K calls versus the 32K calls,
Mm-hmm.
1 by 1.5 or 1 by 2, depending on like how comfortable you are with the break even. Obviously, if you do it 1 by 2, your break even's 34K ish.
Yep.
If you do 1 by 1.5, it's 36. It gives a bit more breathing room, and you can be pretty confident that if we bounce to 34K, vol's going to get annihilated, right? Because you're selling that vol at 100 plus, right? So that's how you tend to structure it, like a little bit long delta, a little bit short vega, and get more short vega in the rally, knowing that vol's going to work for you, basically, right? So that's typically what I do, and I try and find structures that have a break even that I'm comfortable with in that time frame on the upside, and I'm trying to get a leverage in terms of the premium I spend versus how much I can make, leverage anywhere between 5 and 8 to 1 or
Mm.
something like that. That's how I tend to structure it. Yeah.
Yeah, I think those are useful structures, even in the S&P now. Like, and I wanted to bring this chart up. Sorry, I was running some code to pull this up. This is the implied vol for Coinbase this past week. Obviously, the stock hasn't been around for all that long, but the implied vol just, it just went insane. And the other thing that was interesting is look at the put positions that picked up. This is put volume here in the maroon color. This is put open interest and call open interest. And so, the deck ticked so hard to one side that it just really blew volatility out and offered just a really interesting trading environment if you're active in options.
Yeah, and if you haven't got a Coinbase position and you're comfortable owning it down there, then you can sell naked puts, right? I mean, they're an amazing trade down there. Like the vol's well over 100. You don't have a Coinbase position; it's trading at $40. You're happy to sell the $30 put, and you'll probably get some really decent premium for it. And then
Yeah,
if it goes below 30, you sold it in a size that you were comfortable taking delivery in. Then that's a no brainer.
yeah.
I did that trade in Solana and AVAX, and I was selling vol at like close to 300. It was insane.
That's crazy. Yeah, and in the U.S. here, we have a hard time getting access to that derivatives market, the
Yeah.
options market in crypto. So we'll just listen to you salivate over some of those fun trades, and
Mm.
I wish we were there. But so the other, and that kind of segues back a little to the S&P, because the structures that I liked trying to play, rally here, were call flies. Or sort of kind of selling put spreads, looking for that rally. But again, just being very careful, because you don't want to get in that situation where implied vol really drops so hard that you just can't. Your calls lose a lot of value, even though you're directionally correct. You need to buy deltas, really, in this case, deeper, closer to at the money options, in order to, I think, get a relevant payoff. As you can see, obviously after Powell, we've gotten a decent rally here.
Yeah, we've been chopping around back to where we were, right?
Yeah.
But yeah, you're 100% right. Yeah, the worst thing in the world is getting your directional view right and making no money on the
It's
options,
the
because
worst. That is the worst. I
it
mean,
is.
nothing makes me want to go. I'm out of this business when that happens. But
Yeah,
so and then I know we're coming back full circle again, but I want to highlight this. So anyone who has a brokerage platform, I guess we all do, and you look at the open interest right now for tomorrow's VIX expiration, there are big put positions in the VIX at 25 down to 20. I think there's like 200,000 calls, just under 200,000. Excuse me, just under 200,000 contracts each at all those put strikes. And so, again, circling back to the top of the conversation, we talked about this rally that occurred around VIX expiration. I mean, we put this in our founder's note this morning, that this was where VIX expired in end of April. On Thursday, we had a very quiet session, nothing happened, and then Friday, the market just totally mean reverted. I mean, I can't shake that this feels a very similar thing, where the VIX is getting driven down, and I have this feeling it's going to, again, this is a feeling, don't take it to the bank, but I have a feeling we're going to pin somewhere around 25, just above where all these big put positions are. So all those puts are going to be losers, and then that kind of loosens things up, for Friday trading here. But we will see what happens. So far, Powell's helping give us this rally that we're thinking into OPEX.
So I've got a question for you, if you don't mind, Brent. So obviously the price action we saw in volatility last week was very bearish for vol, right? It was
Yeah.
bearish for spot, but it was bearish for vol, right? And given all of the gamma models, typically assume dealers are short puts and long calls. So we're in negative gamma territory,
Yep.
right? As we've traded down here towards 4,000, there's a big open interest here as well. You'd have to assume dealers are probably short a fair amount of puts there, right? Now, do you factor in the fact that volatility is collapsing down there, which is a suggestion that actually the street might not be as short those strikes as we think? Because what if they were part of a put spread? What if a client bought the 4,400 puts and sold the 4,000 puts, had a 400-point wide put spread, and is happy sitting there chilling because it's a June expiry or something, right? And dealers are actually getting sucked into long strikes, which is creating this need for dealers to sell vol and maybe even sell skew. And that's the price action we're seeing in implied vol and implied skew. Is there a way that you factor that into your models, or how do you think about that?
Yeah, that's an awesome question. So we've had this theory, and we've called it the lower bound. We wrote about it. If you Google SpotGamma lower bound, you can read about it. And while we have a base assumption that dealers are short puts, we also believe that they're long tail risk, right? They're long out of the money options, aside from maybe their position put spreads, because that's what people are buying or trading. But as we all know, you can't just be short puts in perpetuity, because if you get a major move and vol jumps higher, everyone's going to get blown out, and that's going to be an awful circumstance. So we've understood this dynamic. And if you just even watch sort of the VIX and said, okay, well, why isn't the VIX, you mentioned some of the skew indicators and things like that. But if you just watch the VIX, the high of the VIX is still on February 24th, which is the day of the Russian invasion into the Ukraine. And despite the S&P being a couple hundred handles lower at one point last week, the VIX still never took out that high. So that is sort of just the most basic indicator you can look at it from our position, saying, look, if dealers were short puts and they were worried about this, we thought vol would be going much higher, right? We thought that we would get this cascade move lower. And the question sort of came back to us is, the options market is at this lower bound. I mean, we have this similar metric called the delta tilt indicator I don't think I posted it here. I can show that in a second. But basically what it shows is that there are these giant in-the-money put positions. We believe that dealers are long tail risk, right? And when vol spikes, that's starting to pay off, and that allows them to provide liquidity to the markets. And that's the whole concept of this lower bound from 4,200 down to 4,000. Now, like you said, we broke below last week. And one of the indicators that I want to turn the question back slightly to you, because you posted something very insightful to Twitter on this topic, is about this delta risk reversal. But let me finish that first thought, is that we had this max put position, but we also knew that there could be liquidations coming from something that has nothing to do with the options market. So even though we think that, look, the options positions are likely full up, vol's not increasing even though the market's going down. Single stocks where crypto is getting rolling sort of liquidations across. But look, if there's margin calls going on, the stock market's going to keep going lower. If fundamental guys are shifting out of equities and maybe they're going back into treasuries now that yields are getting higher or something, I don't know. That's just going to also push equities lower, even though we think that options market makers have sort of a max put position. And also trying to buy puts at this level, right, with the VIX at 30 and implied vol in the S&P, short dated implied vol is still quite elevated. It's just very hard to get a payoff in that sort of situation. And so I wanted to talk about some weird price action for last week, but you pointed out something interesting. So we have this 25 delta risk reversal. It looks at the 30-day options and the S&P, and it looks at a 25 delta put versus a 25 delta call. Now, what's so weird about this, or different, usually when this metric is up around a -6 or -5, that is because calls are getting bought up, usually. And that generally tells you people are trying to get long calls. So this is one way we adjust the way that we look at the market. Now, in this case, no one's really buying calls, maybe some short dated positions, but the bulk of positions are puts. And this indicator is shifting up. And you had noted very adeptly or insightfully on Twitter that when you see this rising up, it's a signal that the dealer's positions are likely full and we could get a rally. And I think you said that 3 days ago or something like that. Walk us through that dimension a little bit.
Yeah, I mean, it's similar to the argument when you're not seeing VIX spike on making new lows in spot. Why is that, right? Why, typically you see some sort of panic. The fact that you're not seeing that from clients, you're not seeing that from dealers, it means they're all pretty comfortably positioned, right? And so that you're kind of reaching that point of exhaustion to the downside. No one's reaching for protection, no one needs it. And then once the last of the selling that's not options related is done, like the retail capitulation or whatever it is, then we can get our bounce, right? That doesn't mean it's going to be a big, strong, sustainable bounce because there's no fundamentals driving it. But the options market is telling you that the panic is in. There's no one reaching for vol anymore. Everyone's got what they need to the downside. Everyone's scenarios are fine. So that panic's kind of close to being over, right? That was all it was. I mean, it's not, I wouldn't say it's a 100% hit rate signal, but you take these signals as a combination, right? You look for these ingredients and then you try and say, okay, what is the probabilistic outcome here based on all the things I'm seeing, and seeing that in VIX, seeing that vol divergence in VIX, seeing skew getting crushed on the S&P were making me think, all right, probably want to be taking some hedges off here. We're likely to get a rally, right? And then we kind of did get a decent bounce off that. And for now, it's kind of hanging in there, right? I mean, it's staying above 4,000. I was looking for it to kind of get to 41.30, between 41.30 to 4,200. I was looking for it to get there over the next week or two before loading up on shorts again, basically, right? But then by then, I think we've unwound a lot of the bearishness. We've squeezed a few of the shorts, and we can do our usual and go back to trending lower, which I think we're going to keep doing for the foreseeable few months.
Yeah, and a few people are talking about this correlation between vol coming off and the market rally, and that is what a lot of people frame as the Vanna trade, if you want to label it. But basically, when that vol comes off, not only the VIX comes off, puts are losing value, not just from the decline in implied volatility, but also from just the decay, right, as we march towards this fairly big Friday expiration. And so all of these puts that are concentrated at the 4,000 level in the S&P, I'll bring that up for everybody here. And then there's a bunch of puts as well at the 300 level in the Qs. Like you mentioned before, none of these indicators have a 100% hit rate, but what you need to do here is you got to put together all of the pieces of the puzzle, right? you can't, in our view, and in my view, I should say, I can't speak for Imran, but in my view, last week, that's a very tough market to short. Like, yes, it is getting dropped hard, right? But Vol's really jacked in single stocks across all these different names, and like you just don't want to buy a put there more times than not, because at that point you're literally betting, I think, on a limit down situation to really get paid out on a put in that there, right? And so, and it's kind of like, it's extreme positioning, and so the smart thing is, and again, this is my point, is that playing the mean reversion trade might be the only trade, and you can do it for fairly cheap with some interesting in the ratio trades that you mentioned. You can get a really good risk reward if there's a rally. Now, if the rally doesn't pay out, okay, you want to control your risk and reward. But with that cascade lower yesterday and the crypto debacle and everything else, it just sort of almost took shorting off the table because it dropped so much. Puts are so expensive. There's a max put position. You see skew starting to turn, all these different things, and kind of the only trade arguably was trying to take a shot at like an upside lotto, right?
Yeah, and like I said, it's similar to the trades we're doing in crypto, right? It lines up pretty well on S&P. You could do a Friday expiry 4,000, 4,100 call ratio. That was coming in at around 20 ticks to make 80 ticks if you get to 4,100. So you get 4-to-1 payout on that. That's
Right.
pretty healthy, right? If that's a scenario you're playing, I mean, we're practically at 4,100 now. Like, you'd need to stay there for the next few days for that trade to pay out, but that scenario is quite possible. On the something that kind of occurred to me on the whole, like, why skew's getting crushed. It's been so telegraphed, like how screwed up the macro backdrop is,
Yeah.
right? And that I just feel that a lot of institutions have probably de-risked so much their equity exposure that
Yep.
actually the put selling may well be coming from the fact that some institutions need to sell puts and buy calls way out of the money to get some participation in a rally in case it happens, because they're so underweight equities, right? So I think some of the discretionary insto community, because I used to see that when I was on the flow desks in banks, right? I'd see hedge fundy type instos who are a bit smarter and using options and stuff. They would just be underweight. They wouldn't own the market because they didn't like it. But whenever we reached these kind of really extreme low points of sentiment, they'd come in and sell puts and buy calls naked, not willing to dip, not willing to change their allocation, but just knowing that in case we got a snapback, they'd participate in some of that upside, basically. And they had no problem selling those puts because they were so underweight. Those puts effectively get them back towards a bit more allocation if the market dumps another 20%, which is probably fine, right? So
Yeah.
I think that put flow, I think that skew selling that we're seeing is partially coming from those type of flows as well. Yeah.
That's a beautiful observation. I would also say that I think a lot of the selling has been, I mean, meme stock, ARK, speculative tech has gotten crushed in a way that like the S&P really hasn't, right? So the S&P also, I think, has probably gotten a lot of rotation into the S&P out of tech and out of NASDAQ, and the S&P is outperforming. And I think there's certain sectors that are obviously doing a little bit better, energy and things like that. And, Apple's down, I don't know, 10 or 15% off its high, which is real. But when you compare that to, some of the moves that we've seen, a la Facebook, Netflix, PayPal, some of this stuff's gotten just taken, out to the garbage. And so I think you're right that it's not, there's pockets of equity selling, and certainly this goes back to the capitulation argument in a way. Still haven't seen capitulation where just everything, baby in the bathwater all goes out, right? It's been a kind of controlled, and more to your point, this was sort of telegraphed, right? What Powell was going to do at the tail end of last year. And if you look at the put position, it drops. So as this delta reading drops, it tells you that puts are going more in the money. There's a larger put delta position relative to calls. And when this drops, it's a bearish indicator, right? Or it tells you that that puts are in the money. That dropped in the beginning of January. This is the March of 2020 low, and it stayed down there for this entire year so far. We're already halfway through this year, which told me that, look, these big put positions were put on. They were entered into probably at the end of last year, kind of to your point, and they just keep getting rolled down and out. Every quarter, as these big put positions go on. June is a huge expiration, about a month out from here, and so that's why I think we get 2% down days, right? We're not getting 5 to 7% down days, despite the fact that it seems like risk is escalating, right? Despite the fact that look, the Ukraine situation popped off and they may default, and all these other China lockdown, blah blah blah. it's keeping the pressure lower. But we didn't get that 60 VIX with a 7% limit down day, at kind of any point.
Yeah, I mean, it's like the cohort who has got that discretion to sell has already sold, and the people who are buying are the passives, right? The passive flows, the corporate buybacks. I mean, the authorizations for corporate buybacks are massive this year. Apparently, $5 or $6 billion of Delta is going to get bought every day for the next month, right?
Yeah, I mean, Apple and
And
Google alone are just
yeah,
it's
Apple,
insane.
Google, Facebook, Microsoft are all doing massive buyback programs. They're price insensitive pretty much. You got passive inflows coming in from the pensions and stuff like that. Those are the things that have been buying. Those are the forces that have been buying the market, right? And then against that, you've got all the discretionary guys who've been getting out and shorting it and being more tactical around it. And they're not in it. They don't have a need to panic, basically, right? Because they're already light in terms of positioning.
Right. Yeah, it's a very good point. And one of the things that I also want to mention, somewhat similar to this capitulation point. I mean, the story or what has supported a lot of the worst stocks and a lot of these kind of crypto names, that those stories have changed drastically, and they're getting punished, right? And if your earnings aren't good, you're getting punished. But someone mentioned before, earnings at Home Depot, that was okay. I think Walmart is quite down to the weakening consumer, but so far it's not. Those aren't the doldrums of or the it's not March of 2020 in terms of the panic level across. And the other problem, here, the interesting thing was from last week that I want to bring up with the VIX conversation before is that when you get these situations where people are so short and you're getting these capitulation moves, that move last week, I don't know if you caught it, it was on Thursday or Friday, right here, in a bunch of these meme stocks and a bunch of these most speculative names. I mean, GameStop rallied 30% intraday, got halted on that rally, right? These types of trades are margin call types of trades to me, right? This is when a risk officer comes and says, all right, you're closing your book up now, because no one's going to enter a long position unless it's an error. And this happened in a whole bunch of different names. And we also saw positive deltas at all the same time in all these really speculative names. These are the types of capitulation events that are taking place. And so there's like localized capitulation, right? There's localized liquidations, but equities still, I mean, I hate talking about capitulation because that's what everyone is focused on. But, you're seeing capitulation is just not in the S&P 500 because it still is the best game in the world, I think, right? The highest
Yeah, but
quality.
exactly. It's going to be the last shoe to drop. It always is, right? So there's a lot more weak spots around the world, typically. I mean, it's funny, like people get all excited about buying Europe on relative valuations and blah, blah, blah. And then first sign of trouble, Europe just pukes so much harder than the US every single time, right? So, yeah, I mean, the S&P is the flight to safety in the equity space. It has been for a very, very long time. Will continue to be. I mean, the fact that it became so tech heavy with those mega cap techs, that's what made it potentially a little bit more fragile, right? In that if those techs bellwethers need to re-rate because of rates going significantly higher, right? Then that we're starting to see that, right? We're starting to see Facebook massively derating, Netflix massively derating. I mean, like I say, Apple's still kind of hanging in there, but Amazon's massively off its highs as well, right?
Yeah,
So,
huge.
I think Microsoft and Apple are probably still hanging in there on a relative basis, but
Yep.
Amazon's been crushed, Facebook's crushed, Netflix crushed. So all of them, they're kind of one by one, the generals as they're called, they're
Yeah.
dropping. So
And I think of the generals, Tesla's arguably the last one that hasn't quite. That Kramer had his generals, and Tesla's kind of the last one that really hasn't gone full Netflix, so to speak, yet. I mean, this chart is just like it's unbelievable.
it's amazing.
Who's gonna? I don't know who wants to buy this right now. Maybe it. I don't know. I'm waiting some fundamental widers that are probably gonna get a few people.
So you obviously got all your subscribers short Netflix before that happened, right? Just check.
Yeah, I saw there's earnings coming for that. No, I had no idea. But and it doesn't have a consistently strong options position. So I think in a lot of these names, though, you get vol spikes so much that might just wait for a good play in the options market when vol spikes after the fact. The event's out, you kind of know what's going on, and oftentimes you can get some interesting setups. And to that point, I think for the last 2 years, for sure, this dip would have been bought. I mean, it wouldn't have fallen 20% in the first place, but the dip would have been bought so hard, and now it doesn't spike at all. There's a little wick there, but Facebook and PayPal and stuff is the same thing. Like, yeah, it dropped 20%, but I can't. I mean, I'm sure someone's done the study. Back to back quarter where your stock drops 20% on a mega cap stock like Netflix. I mean, that's amazing.
I mean, Facebook did something similar, didn't they? And they had a few, like this time round they did well, but the previous few quarters they had a shocker, right? So,
Yeah.
but yeah, I mean, the market's just less forgiving now, right? It's
Right.
just that's the liquidity is being withdrawn. The earnings just if earnings disappoint, they get punished, right?
Yeah.
People have got no more patience for it, right? They want stocks that are safer, basically, and that's why you're seeing this rotation towards utilities, staples, healthcare, right? That's a sign under the hood that people just want to park themselves in equities that they deem safe
Yep.
because they know the macro backdrop is so precarious, right?
Yeah. So I think we're coming up towards the top of the hour. So I know we're getting a lot of questions here on just kind of our view over the next couple of days, how this may play out. I think you and I are on a similar page that we're looking for a rally here. We've been looking for a rally, as we've been talking about in our sort of subscriber notes, and that is off the basis again of implied vol dropping into VIX expiration, puts getting burned up, etc. I think that there is some potential to get over 4,100, but I lose a lot of conviction as we get over 4,100. Particularly into Friday. And if we hold up over 4,100 into Friday, then I think that just drains a lot of the rally fuel out because of the fact that most of the puts are down around 4,000 at the moment. So I think in general, looking for a rally here, and then that's clearing out some put position. And so we could see lower lows kind of in the future. Flag June OPEX as a major event. I don't know, obviously, how the market's going to trade into that event, but mark it on your calendars as a major turning point, maybe from a high to going back to a low, or a big buy the dip opportunity. I don't know which one will be yet, but mark that. And so I'm looking for the market to more or less pin the 4,100 area here, and then potentially even some weakness on Friday, just off the fact that we've already burned up this, this Vanna charm fuel already on this rally. And do you have a kind of a similar synopsis here? What's your
So I agree this week. It's definitely being impacted by the charm of those puts that are parked around 4,000. So you're going to get a bit of futures buying coming into expiry. We needed to unwind this oversold condition. We kind of done that. I'm probably a little bit more bullish than you, just because at the margin, I don't think we're going to get that much new news in the next 2 weeks with regards to what we already know, right?
Right.
We already know. We already know what the China. I think at the margin, I think we're probably going to get better news out of China than we currently expect. I.e., they might reopen sooner, right? And we're not really going to get any inflation data for a little while to get to see, has inflation really peaked and stuff like that. So I think we might get this kind of news vacuum for a week or two, where you're not getting a lot hitting the tape. And you got these buybacks coming in, buying 5 or 6 billion a day, right? And you've already had a load of people puke the market, right, and get out of the market. So I just don't know if the marginal seller's there for the next week or two. And if they aren't, given how far we've come, I don't see why we can't continue short squeezing a bit more, right? So whilst, I would probably start to add shorts at 4,200, I wouldn't be stopping out of those shorts at 4,300, right? I'd be leaving myself room to add. It could extend a bit further than I think, right? That's what these short squeezes often do, that, right? You get
Good
a
point.
bounce, you think, well, it's a short squeeze, so I'm going to sell it, and then it goes another 200 points in your face. And it still is a sell, but you just got to give yourself the bullets to be able to do that. And that's where options are quite useful. The way I would do it is buy put spreads as we rally, probably out to July, maybe August, because I think we'll rally over the next 2 weeks. I had some Junes on already. I was able to monetize some of them. But that's kind of how I'll approach it, basically.
Yeah, you raise a good point, and in the fact that these short rallies can extend, farther than you can expect, and And just the fact that these puts are rolling off doesn't mean that the market has to trade lower. That we should be clear on that. I just think that if you do start to turn lower, and we sort of had this 4,000 level as a rough bottom, well, maybe you want to start to discount that what is possible on the downside. You bring up some good points on the extension on that extension higher. Somebody asked here about Tesla, and do we think it needs to collapse? I don't think it needs to collapse. I have no idea what may or may not happen with Tesla. I don't follow the fundamentals. I certainly don't know what's going on with Elon Musk and Twitter and his collateral and all these other types of things. I just simply note that it was the last one that hasn't, Netflixed of Kramer's General. So a couple comments on Tesla there.
I think in general, Tesla's going to have some beta to the market, right? So if you believe that the broader market needs to re-rate lower, the guys who do sort of the more fundamental valuation side of things are looking at multiples, looking at what they call equity risk premium, right? So your equity risk premium is basically the difference between the 12-month or the forward earnings yield of the market compared to real interest rates, right? You take that differential and you compare that to historics and where it's been, basically, right? And that measure is kind of looking at the relative value between owning stocks or bonds, okay? And while stocks have derated, arguably there's still room for that because real yields have gone up so much, right? Real yields have gone from -1 to -0.5 nearly, basically, right? So it's just, you've got to look at that in the context of where bonds are and say, yeah, actually, equities don't really look cheap until they go down another 15-20%, basically, right? That's kind of, so you just need to be aware of that. And if you buy into that sort of valuation and that idea, then yeah, Tesla's going to go down with the market, right? It's just it's a matter of when, right?
Yeah, it's a very good point. And honestly, to your idea of the rally extending a little bit, I mean, we haven't seen what Powell has to say yet, but there was a pause, at least a brief pause here in the 10-year, which a lot of people have been flagging. Maybe that's a little bit of relief. And the rate game, I think, we're not going to bottom until people really understand what's happening with rates. And so it's probably going to be a situation where they go, look, we're having one of the worst recessions of all time. We're going to stop hiking, and then the market will start to rally because bad news, horrible news is good.
That's what happened in March 2020. After 35% sell off in 2 weeks, we're staring at 100-year depression. Yeah.
Yep.
And then they print however many trillion, and the market goes up in a straight line for the next 2 years.
Don't forget those big puts expiring in March.
But before we close, I just want to ask you, the June JP Morgan put spread collar trade that expires at the end of the month. Do you know what the strikes are on that put spread?
I just was looking at those. Someone will be able to put them in the chat. I believe the calls were at 4,300.
Okay.
What were we trading? I believe the calls are trading at 4,300, and I don't remember where the put spread is. I can look it up quick.
Because that put spread, that long strike on the put spread is likely to get tested. And that's the dealers are going to be long that in some size, right? That's like 20 billion notional, that trade, isn't it?
Yeah, that's correct. And it seems because that position gets so deep in the money now that there's a chain of events of if that strike is in the money or if one of the strikes is in the money, how does that affect the roll? And how does it, kind of wag the market in between there? So I'll have to look up exactly where those strikes are. But I believe one of those is actually in the money. I'll put that in the subscriber note today. But we're trading sort of in and around that area. I think maybe at the low last week we were testing one of those strikes. I was gonna mention that the port 4135. Thank you, Paul, very much. I knew Paul was watching. He knows everything.
So was it
4135 is the S&P long leg.
But what about the short leg on the put spread?
The short is in the 30. I want to say 3600.
Oh, is it? Okay.
Yeah.
Okay. Yes, I mean that, and those June 3600s are probably quite low delta, right? They're probably 15 delta puts right now, I guess, given where vol is off the top of my head. So that's downside, right? That downside that's getting offered, that downside that's getting crushed is because the street's sitting there long your amount of 36 puts effectively. In 20 billion notional to June, right? So
it's a lot of size. If you look at just the overall deltas in the expiration, it's just there was big positions there anyways. So here's the total gamma and delta expiring for Friday, which is this is a decent amount of delta and gamma expiring. Typically over 30% is where it gets really large. But if you look at the June expiration here, you can see what the forecast is at the moment. I mean, this is a lot of deltas. That's a lot of in the money puts that are expiring. So 36.20 is the short. Uh,
36.20.
yeah,
Okay.
roll it. I don't know how to pronounce your handle there. And rolling Nabeed, thank you very much for letting us know. We should know this off the top of our head, and so I'm standing here like a deer in headlights.
Yeah, I mean, so that basically tells you, right, that there's a pretty high probability that vol's not going to spike that hard until the market breaks 3,600, right? I thought when we broke 4,000, we were going to get a vol spike. We didn't get one, right? So now when we retest 3,800, you're going to be what, 200 points away from a 20 billion notional long strike for the dealers. Vol's not going to spike down there, right? And the guys, the JP Morgan guys, aren't going to touch that put spread. They're just going to sit on it. So
Yeah,
I reckon you're not going to get a real super duper vol spike to like 50 plus unless we break that put spread strike, get away from it, and go into territory where the street isn't long anymore, right? So it'll probably be a continuation of the kind of dynamic that we've seen where vol underperforms the sell off like we've seen over the last few weeks. Yeah.
yeah, that's some very interesting insight. And so, and I think it makes sense, and that's kind of the idea of exactly what you said. You go from the position where they're long to short, and that creates the cover, which creates puts demand, and that causes vol to increase. So, all right, Imran. Well, I know we're coming up on the top of the hour here. Your insights are very valuable as always. You want to mention to people how they can get a hold of you?
Sure, sure. So options_insight is my Twitter handle. Options-insight.com is my website. We obviously we do training courses. One of them sits on the SpotGamma Academy. It's called The Hedge. So check that out if you want to learn about options. And I think now is the market where you want to know about options, right?
Yeah.
But then I also run my own boot camps and things like that. I've got one coming up in July, which I'm doing in conjunction with 42 Macro. For those of you who know my good friend and Brent's friend Darius Dale, so he's going to be attending my boot camp in July with a bunch of 42 Macro subscribers. But anyone's welcome to come. And yeah, feel free to you can book a 15-minute call with me from my website as well, me or my team, and we can have a chat about the market and what you guys want to do in options, basically.
So free 15-minute calls to Imran. That's a good offer, man. I might have to call you myself. That's cool.
Anytime, anytime.
That's what's going on. So, and we are at SpotGamma on Twitter. You can reach us at spotgamma.com. Academy.spotgamma.com is our course offering with Imran. He's got his handsome photo up here. And if you have any questions, please leave them in the comment section, and we'll be happy to get back to you. Thanks for taking the time to watch, and we'll see you next month. Next options expiration.
Thanks for tuning in, guys.
Hey, that's the big one too, the June OPEX. So
yeah, we'll be there.
all right, see you, buddy.